The crazy part is assuming that things will play out precisely to the day and this is exactly the bottom. That's insane and wrong. The correct part is like, this is a natural cycle where we get overly bearish, and then the people who buy when you're overly bearish do really, really well. This is just a moment where the news is really good and the vibes are really bad, and that disconnect is potential profit. You have the CEO of BlackRock, the world's largest asset manager, saying every asset will be tokenized. You have Paul Atkins, the chair of the most important regulator, saying every asset will be tokenized. You have every major Wall Street firm hiring people to tokenize it. Like, the world is screaming at you that everything is going to be tokenized. We're going to go from 20 billion to 200 trillion. And crypto's like, nah. They won't listen. And I think that is just a really significant opportunity.
In every market cycle, there comes a moment when perception and reality violently diverge. Prices fall, sentiment collapses, and the narrative becomes singularly focused on risk. In those moments, investors lose the ability to process good news. Fear compresses attention. All that remains visible is downside. According to Matt Hougan, this is precisely where we find ourselves in crypto today. When markets are under threat, he argues, investors can only see the immediate danger. In a bear market, risk dominates the psychological field of vision. Positive developments are acknowledged briefly, then dismissed. Major adoption milestones barely register. Structural improvements go unnoticed. The emotional bandwidth of the market shrinks. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
When you're under threat, the only thing you can worry about is the immediate threat. And so when you're in a bear market, the only thing you can see is risk. And all the good news that happens is sort of beyond what you can process. You mentioned the Uniswap example. I'll give another one. Yesterday, Meta announced it was rolling out stablecoins across 3 billion people. And we talked about it for like 12 minutes. A few years ago, Meta tried to move into stablecoins. We talked about it for 12 months. There's 3 billion people who are going to have crypto wallets in a year. It's like ridiculous. And the price is like, I think the point I was making in the memo is, look, most of the biggest alpha opportunities you'll ever encounter as an investor are behaviorally driven. It's when people make classic behavioral mistakes and there's a gap between perception and reality. And the reason Ryan is more bullish than he's ever been is the gap is bigger than it's ever been, in my view, in crypto. The reality is Meta is rolling out stablecoins to 3 billion people. The reality is BlackRock is investing in Uniswap and Apollo is investing in Morpho. The reality is Stripe just said all internet transactions will take place over blockchains and they're the best payment company in the world, right? The reality is Circle just reported blowout earnings. Everyone's building on tokenization and crypto is like, life is terrible. That is alpha. It doesn't mean it's alpha tomorrow, right? Like, I'm not, the thing about the chart you showed is it's both genius and crazy. The crazy part is assuming that things will play out precisely to the day and this is exactly the bottom. That's insane and wrong. The correct part is like, this is a natural cycle where we get overly bearish, and then the people who buy when you're overly bearish do really, really well. This is just a moment where the news is really good and the vibes are really bad, and that disconnect is potential profit. So we're excited about tokenization. There's $20 billion. Stocks are $110 trillion, right? Bonds are $140 trillion. Real estate is like $250 trillion. ETFs are $30 trillion. The point I made in the memo is that the tokenization market could 10,000x and still have room to grow. And while that sounds like a crazy idea, you have the CEO of BlackRock, the world's largest asset manager, saying every asset will be tokenized. You have Paul Atkins, the chair of the most important regulator, saying every asset will be tokenized. You have every major Wall Street firm hiring people to tokenize that. Like, the world is screaming at you that everything is going to be tokenized. We're going to go from 20 billion to 200 trillion. And crypto's like, nah. They won't listen. And I think that is just a really significant opportunity. I would add, just to make this concrete for people, you're seeing this in other parts of the market, right? So in July of last year, the SEC chair said, I wish there were super apps that combine stocks, bonds, prediction markets, futures, et cetera. And now Coinbase has turned on stock trading, right? So regulators act, people listen. The chair of the CFTC said prediction markets are okay. And now the CME is building prediction markets. And these are going to be multi-trillion-dollar markets. The chair of the SEC also said everything will be tokenized, and everything will be tokenized, right? Like every fact points to say something, it happens in the real world. So I really think it's going to happen. And I don't think people have contemplated the scale of it yet. Stablecoins will gain traction in the areas that are not best served by the traditional finance system first. That's what we're seeing in the crypto markets, in offshore transactions, in countries with poor currencies, et cetera, long before we use them here in the dollar, but in the US to replace like standard dollars. But I do think it's going to happen faster than the market expects. And the primary catalysts, certainly the Genius Act going into effect in a handful of months will be a major catalyst. I think this agentic idea is a major catalyst. So yeah, it always takes longer, but it always ends up bigger than you think.
Stablecoins in Hougan's framework will gain traction first where traditional finance performs poorly. Emerging markets, offshore transactions, countries with unstable currencies, cross-border settlements. These are the environments where dollar-pegged digital assets offer immediate utility. They may not immediately replace dollars in everyday American transactions. But in regions underserved by traditional banking, stablecoins represent functional monetary infrastructure.
I have this thesis on equities like Circle and Coinbase, which is they have this unique advantage that the regulatory environment was so hostile that the period where natural competitors would build up in their markets never happened. So there's no reason that Coinbase should have the market share it has. The reason it has the market share it has is well-funded competitors were hard to come by. You had Kraken, which is doing exceptionally well now and gaining share, but it has a far larger position than it should, right? It should have been like the brokerage market where there was Schwab and Fidelity and Interactive Brokers and E-Trade and all these other people competing for share. And that didn't happen for Coinbase, and it didn't happen in stablecoins for Circle. So it has a lead that is bigger than it should. And I suspect it's going to be able to sustain a big chunk of that lead, even as other competitors come into the market. So yeah, I think it has this embedded regulatory moat that it shouldn't have, but it does. And it's pressing that advantage. And it looks like it's going to stay ahead to me. I think Meta is more of a challenge to wallets like MetaMask and Phantom, and maybe brokerage apps eventually like Robinhood, than it is to Circle. I think they'll probably use other stable coins at this point just because they had such a challenging environment. But they are the distribution engine and a natural home for wallet exposure, which I think is the way I would think of their entry into the market. My guess is they'll use third-party stablecoins at this point.
That makes sense.
And if they did, then no, right? Effectively, no. They're probably obviously better off in the current regulatory environment using a third-party stablecoin and sharing yield from distribution. That's almost the way regulators are driving the world, is to create these partnerships. And so that's probably what you're going to see because regulation is important, right? Coinbase offers yield. If it had its own stablecoin, it couldn't. That's weird, but regulation does weird things to the world, right? So that is what the world is telling you it wants this ecosystem to look like. That's probably good for Circle, and it means that's going to see the experimentation that you see by these firms. Look, the prediction markets are slightly more bullish than I am. I think it's like strictly a coin flip, and depending on which prediction market you use, it will tell you it's slightly better than a coin flip. But I don't know. I think coin flip is the best estimate. Look, it sounds like we're getting closer to a solution on yield. I think this will really come down to Democrats and Donald Trump hatred and whether that deep sixes the Clarity Act versus fear of the crypto lobbying effect in the midterms and what happened to Sherrod Brown happening to other people. I think that's actually where the rubber will meet the road. I guess if I had to choose, I take the over and say it passes, but I do think it's pretty close to a coin flip at this point. I wish someone had told me about this 10 a.m. guaranteed dump 6 months ago so I could have profited from it every single day. It's remarkable that it's only after the fact that we find out that everyone knew that this was happening. Look, the reason crypto is down is because people who held Bitcoin at the start of 2025 sold it. That's it. That's the reason crypto is down. The problem is actually in the mirror. It's not someone outside. It's us looking at each other and saying, like, we crypto sold Bitcoin and the price went down. I think the Jane Street story has to be fractured into multiple different parts if you want to dig into it. So there's the Terra Luna question, right? Terra Luna was doomed from the start. There's a reason Bitwise never put it in our index, right? It was doomed from the start. And the question of whether Jane Street used insider information to profit on it is something that we'll find out in court. I have no particular view. The question of whether there is some weird magical arbitrage between Jane Street and how ETFs are created and a 10 a.m. dump just has no actual logical path if you know how ETFs function. There's literally no way for Jane Street to profit in the ETF market because they're dumping. I've seen so many terrible takes that are just not backed by how ETFs work. I was CEO of ETF.com, so that story is untrue. The question in the middle is, did Jane Street ever look at leverage markets and create a cascade of liquidations to put the price? That's a broader question in crypto, right? A lot of people have said forever that the fact that you can see the leverage liquidation levels in the market causes some people to create cascades in those markets. I don't know. But the latest iteration that there is this weird nexus between Jane Street ETFs and a 10 a.m. dump that we only found out about after the fact, that one is just false. So these other two, I don't know, but that one is just false. So obviously we've been following the prediction markets with you, which are a close cousin to crypto. And recently we filed for 6 prediction ETFs under a sub brand of Bitwise called Prediction Shares, which I think is a fantastic brand. And I feel very proud that we bought the URL like 6 months ago. They provide exposure if they were to launch to the Democrats winning the presidential election or the Republicans winning the presidential election. And the same thing for the 2026 elections in the House or the Senate. And the core thesis is, of course, you can get those exposures through the prediction markets today, in the same way that you could get Bitcoin exposure through Coinbase in 2023. But the ETFs unlocked Bitcoin for a large number of investors who didn't feel comfortable working on a separate app. And we think ETFs can do the same thing on prediction markets. My view is that prediction markets are one of the most important financial developments over the last 10 years. And I think they are going to be 10 to 100 times larger in the future than they are today. I think they're systematically important and broadly good for society. And the prediction shares ETFs are trying to fit that into an ETF wrapper to let people access those financial returns in their traditional brokerage accounts. So we're hopeful and excited to bring them to market. And we'll see how that filing process goes. I'm limited, but what I can say to what's in the filing. So I'll say what's in the filing, which is they aim to get exposure through swaps and or owning the contracts directly. So, but the goal is to provide exposure to those election outcomes in an easy to use wrapper. You can find it in the prospectus. It's on page 2. It takes a while. These are 40 Act registered products, so the timeline is faster than the timeline you're used to on a Bitcoin ETF, but there is no guarantee that they will launch. I should say the timeline for a traditional 40 Act product is measured in something like 70-ish days. These are relatively novel, so it can take a long period of time. I can't tell you if or when they will launch.
Markets are cyclical. Sentiment overshoots. Fear narrows perception. Matt Hougan's macro thesis is not built on short-term price predictions. It is built on observing structural momentum beneath negative sentiment, stablecoins expanding to billions of users, asset managers embracing tokenization, regulators articulating blockchain-native futures, exchanges evolving into financial super apps, prediction markets integrating into traditional finance.